Welcome to today's Explainer. We're diving headfirst into the core concepts from the Wealth Preservation Blueprint. Right off the bat, we are going to shatter one of the biggest, grandest myths in personal finance. You know the one, the idea that a massive salary automatically equals massive wealth. Seriously, it's a trap, and it catches some of the absolute smartest, hardest working professionals out there. Today, we're breaking down exactly why that happens.
High income doesn't mean high wealth.
This is where most high earners go wrong. We are so conditioned to think that getting that massive annual bonus or hitting a shiny seven-figure salary means we've completely crossed the finish line. But here's the reality check. Income is just a number flowing in. Wealth is what actually stays with you.
Okay, let's dive into this. The high income illusion, where high earners go wrong.
Mistake 1. Lifestyle inflation.
First mistake, lifestyle inflation. The more they earn, the more they spend. It's this crazy, direct behavioral correlation that completely neutralizes a high income. Think about it. You get a raise, and suddenly the baseline for your standard of living just magically shifts upwards, right? Every single new dollar is immediately assigned to a new, more expensive habit. So what happens? You end up with a much higher cash flow, sure, but literally zero extra net worth.
Moving to mistake 2, no investment plan.
Second, no clear investment plan. Money just sits or gets wasted. And this brilliantly illustrates the danger. Without a designated strategy for every single surplus dollar, those funds just vanish. If your capital is just chilling in a checking account, it's constantly losing to inflation. And if it isn't deployed into a structured portfolio with proper asset allocation, well, human nature takes over and it evaporates on impulsive spending rather than actually compounding for you.
Mistake 3, income-only focus.
Third, relying on income alone, not building assets that make money without them. High earners often trap themselves in this sort of golden hamster wheel. They rely 100% on their own physical or mental labor. But true wealth, that comes from building autonomous assets. Because if your cash flow drops to zero the very second you stop working, your financial foundation is actually incredibly fragile.
Mistake 4. Ignoring taxes.
And finally, ignoring taxes and financial structure, so they lose more than they should. High earners get so hyper-focused on that top-line gross income that they completely neglect the leaks in their bucket. Without proper tax planning and entity structuring, they essentially bleed capital. Capital that absolutely could have been legally preserved, invested, and compounded for their future.
So, when you combine these four blind spots, lifestyle inflation, no investment plan, relying on income alone, and ignoring taxes and structure, you see exactly how the high earner gets hit from all sides. They spend their raises, let the surplus stagnate, rely purely on active labor, and then leak whatever is left to a total lack of financial structure. Honestly, it's the perfect storm for financial stagnation. So the crucial point is keeping and growing wealth.
You don't build wealth by earning more, you build it by keeping and growing more. Earning is really just the raw material. The actual, proven mechanism of becoming wealthy requires dodging that lifestyle inflation, plugging up those financial leaks, and aggressively buying assets.
So, take a hard look at your own habits. Are your raises disappearing? Are your savings just sitting there losing value? Tell me, are you making any of these mistakes?